Welcome back to the Market Chronicles, everyone. This is episode 14. Great to have you with us.
Absolutely.
And for those joining on YouTube, welcome. We're about to get into another deep dive. If you enjoy this kind of analysis, definitely hit that subscribe button.
Yeah, these do.
So today, we're looking at some really interesting commentary from Lyn Alden. Specifically, her thoughts on inflation, what really causes it, and the structure of our whole monetary system.
That's right. Alden offers I think, quite a unique perspective. Our mission today is really just to unpack her core ideas on price drivers and the, let's say, technological evolution of money.
Okay, so let's jump right in. Alden starts with a pretty foundational idea, maybe even counterintuitive for some. She argues the natural baseline for prices isn't flat or rising, but actually negative.
Exactly. Because of productivity. I mean, think about it. Technology, better processes, we get more efficient at making things all the time.
So we produce more with less effort, less resources.
Yeah.
Logically, that should mean lower costs, right?
Right. And those lower costs should, in a sort of pure market sense, translate to lower prices for consumers. But that's where things get complicated, especially when you bring money into it.
Which leads to her point about financial assets, specifically currency. The big question she poses is, what's the rate of dilution?
Dilution. Yeah, that's the term she uses. It's about how the value of each unit of currency, like a dollar, gets watered down over time.
And she gives a formula almost. Net dilution equals the money supply growth rate.
Minus the interest rate you can earn on that money.
Okay, so give us an example.
Sure. Let's say the broad money supply is growing at 7% a year. But the interest rate you get on, say, a savings account or a T-bill is only 4%.
Okay.
Well, 7 minus 4 is 3. So you've got a 3% net dilution per year. Your passive holding of that currency means your share of the overall economic pie is shrinking by 3% annually.
And that value, that 3%, it doesn't just disappear, it gets redistributed effectively.
Precisely. It benefits others in the network, often those who are borrowing or closer to the source of the new money.
This ties into her bigger framework, doesn't it? Viewing money problems as fundamentally technological problems. She maps out these distinct eras.
Yeah, 3 main eras based on the underlying tech. The first is, well, ancient history now, the pre-telegraph era. Think analog.
So coins, paper money, the printing press eventually.
Right. Basic stuff by our standards, but revolutionary then. They allowed ownership to move faster, more transactions to happen, but still very physical, very slow in the grand scheme.
Then comes era 2, the telegraph era. Starts around the 1830s, runs right up until maybe the early days of Bitcoin, she suggests.
The key here was the telegraph, then the undersea cables. Suddenly, you could send information, transaction details almost instantly across the globe.
Ah, but there's a mismatch in there.
Yeah.
Information travels fast, but settling the actual transaction, that was still slow.
Exactly. Because settlement often still relied on physically moving gold or reconciling books between banks slowly. You had fast communication, but slow final settlement.
So how did the system cope with that gap?
Centralized ledgers, that was the innovation or maybe the workaround. Commercial banks and later central banks basically kept track of who owed what. They acted as trusted intermediaries.
They could net out transactions internally or between themselves much faster than shipping gold bars around?
Right, but, and this is Alden's critical point, it introduced dependence on these central intermediaries. Trust became crucial. And these central points, well, they can be controlled, manipulated, or fail.
Which brings us neatly to era 3, the Bitcoin era, as she terms it.
Yeah, and the big leap here, according to Alden, wasn't just digital currency, it was fast settlement. Bitcoin, for the first time in maybe 150 years, closed that gap. Transaction speed and final settlement speed could finally match up again, but now globally and digitally.
So her argument is that for a century and a half, money was sort of technologically broken. This mismatch between transaction and settlement created structural issues.
That seems to be her core contention. This flaw wasn't unique to one country. It was baked into the system globally because of the available technology. And it created maybe skewed incentives for policymakers.
How so?
Well, if settlement is slow and clunky, but you control the centralized ledger, maybe the path of least resistance involves managing the ledger in ways that aren't always, let's say, sound in the long run, like expanding the money supply easily.
Okay, that makes sense. Let's shift gears slightly to inflation itself. Alden makes a key distinction between structural and temporary inflation.
Right. Structural inflation for her is pretty straightforward. It's sustained growth in the broad money supply, period.
And temporary inflation.
That's more about price spikes caused by specific events that hurt productivity. Think a war disrupting supply chains or a bad harvest causing food shortages.
So prices go up because supply gets constrained, not because there's fundamentally more money chasing the same goods.
Exactly. And the key difference is that if the money supply isn't growing rapidly, these temporary price hikes tend to resolve themselves. Either production recovers, people substitute other goods, or prices elsewhere might even fall to compensate.
But for prices across the board to keep rising year after year,
You need that underlying growth in the money supply. That's the necessary condition, in her view.
and this inflation shows up in different ways, right? Not just the CPI number we always hear about.
Oh, absolutely. There's consumer price inflation. Sure, the cost of your groceries, gas, services going up. But even within CPI, the rates vary wildly. Like hospital services might be soaring.
While electronics might be getting cheaper, relatively speaking, because tech improves so fast.
Precisely. So your personal inflation rate really depends on what you buy. And obviously, if prices are generally rising, you need your wages to keep up just to stand still.
But there's the other big one, asset price inflation.
Yes, stocks, housing, gold, maybe Bitcoin now too. When the money supply grows quickly, especially if productivity growth is decent but not spectacular, a lot of that new money doesn't just chase consumer goods, it flows into assets.
Pushing up their prices,
Yeah.
which is great if you already own those assets.
But makes it much harder for people trying to get into the market, particularly housing. It becomes a barrier to entry.
This ties into her historical comparison, the 1970s versus today. Things were different then.
Very different. In the 70s, you had high inflation, yes, but also high interest rates. Saving money in bonds actually gave you a decent real return sometimes.
So there wasn't the same desperate push to get out of cash and into hard assets.
Less so. And housing, while obviously essential, was maybe viewed more as just, a place to live, a utility, rather than the primary savings vehicle it's become for many. Prices were lower relative to incomes.
But then interest rates started that long structural decline.
Yeah.
We've had decades of currency debasement or money supply growth outpacing economic growth.
Right. And that changes behavior. If cash is losing value consistently and borrowing becomes cheaper, suddenly real estate or other scarce assets look much more attractive as a way to preserve wealth.
Which feeds demand, pushes up prices, you get more speculation, people buying second homes, maybe not even to rent out, just as an investment.
And Alden points out the dynamic where if mortgage rates are low but the money supply is growing fast, people who can borrow effectively get access to cheaper and cheaper money to bid up house prices, pricing out others who rely more on savings or wages.
There's also that debate about house size versus quality. New houses are bigger, sure.
But is the quality per square foot the same? Or are we just getting bigger boxes made with less durable materials? It's a complex picture.
The bottom line, though, seems to be that affording a home takes significantly more work, often requiring two incomes where one might have done before.
Yeah, the affordability metrics generally point that way, which leads us to the Cantillon effect.
Ah, yes, Cantillon. Explain that.
It's the idea that new money entering the system doesn't spread out evenly or instantly. Those closest to the money printer historically, maybe the king. Today, think large banks, the government, well-connected corporations get to use the new money first.
Before it circulates widely and bids up prices.
Exactly. They get to spend it when prices are still relatively low. By the time that money filters down to, say, wage earners or people on fixed incomes, prices have already started to rise.
So the early recipients benefit disproportionately. They can borrow fiat currency, perhaps at rates lower than the actual rate of monetary expansion.
Effectively shorting the currency, as some would say. They borrow something that's being debased to buy real assets that might appreciate.
While people further down the chain, maybe with less access to cheap credit or facing higher banking fees.
They feel the effects mainly through rising living costs and find it harder to benefit from the asset inflation side. It tends to reinforce wealth concentration.
This touches on that sensitive topic of unfair wealth concentration. Alden seems to distinguish between wealth earned by, say, inventing something amazing.
And wealth gained primarily by being strategically positioned near the monetary spigot, exploiting the mechanics of the system itself.
There's a critique there of roles that seem more about extracting value from the financial plumbing than creating new value for society.
And political influence plays a role too, doesn't it? Decisions about bailouts, regulations, who gets access to central bank facilities. These things aren't neutral. They often benefit those already close to the levers of power.
Creating a feedback loop. Wealth buys influence, which shapes the rules to further concentrate wealth.
That's certainly a significant part of the critique that arises from this line of thinking.
Okay, so let's try to wrap this up. Key takeaways from Lyn Alden's perspective here. First, the idea that productivity should make things cheaper, and persistent inflation is fundamentally about money supply growth.
Second, understanding money through its technological evolution, those three eras, the settlement mismatch problem and how Bitcoin potentially resolves that, it provides a really useful historical context.
And third, the consequences.
Yeah.
How this plays out in consumer prices versus asset prices, the impact on housing affordability, and the distributional effects described by the Cantillon effect.
Yeah, it gives you a framework for thinking critically about these really big, fundamental economic forces that shape so much of our lives.
Absolutely. You're hopefully now better equipped to analyze these dynamics yourself.
So here's a final thought to chew on. Building on Alden's technological view. If money has evolved through these tech stages, analog, telegraph gap, fast settlement, what might the next major technological shift be?
Good question.
And how could that next leap potentially reshape our ideas about value, about wealth, about how our economic system functions? Something to ponder.
Definitely food for thought. Keep exploring these ideas, everyone. Thanks for tuning in to this deep dive.
Thanks, all.